This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gordon Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Andrew Sheng with us, joining us this morning in Malaysia. Andrew is a distinguished fellow of the Fung Global Institute, a member of the UNEP Advisory Council on Sustainable Finance, a former chairman of the Hong Kong Securities and Exchange Commission, and when he's got some other time, he's also a professor in Beijing. So Andrew, you really get around the globe in Asia.
Oh, mostly Asia. I don't travel that much outside Asia, but I do occasionally come to the States.
Well, I believe you were educated in England, were you not?
Yes, I was educated at the University of Bristol.
So you've got quite a background here. Could you, for our listeners, Andrew, give us maybe a brief overview of your background and the things that you're involved with currently?
Well, I'm a former central banker. I've worked in the Central Bank of Malaysia, Hong Kong Monetary Authority, and then I became a securities regulator for 7 years in Hong Kong. So my background is basically central banking and regulation. I have, written quite a lot about finance, especially a book published by Cambridge University Press called "From Asian to Global Financial Crisis." That was a review of the Asian crisis, but I saw it as a precursor to the current crisis, and it still hasn't finished it yet, in my opinion.
I would agree very much with that comment. Andrew, it's a real pleasure to have a former central banker and regulator on, because we've had so many people that are not of that background, and to have somebody with your experience and training to talk about financial repression, which is what we're here to discuss here this morning, is a real honor. Can you define financial repression in your words for our listeners?
Well, financial repression was actually introduced by the late Professor Ron McKinnon from Stanford. He wrote this book on the subject back in the 70s. And it really sort of sparked the whole process of financial repression for development. What happened was, of course, is that governments tend to pay depositors very low rates, sometimes below inflation rate, in order to fund the budget. And the result is that that's what is known as a financial repression tax. And that basically represses the development of the financial system. And Ron was very, very shrewd. I think he should have won a Nobel Prize for this. He highlighted this aspect, and it's still true in the emerging markets, in many emerging markets. But of course, the advanced markets now has moved into financial repression, with the Fed and the leading central banks bringing interest rates down to near zero. Okay. Well, what has happened is that when the advanced central banks, advanced country central banks, bring the interest rate down to near zero, the biggest payers of that tax is actually the pension funds, the insurance companies, and long-term savers, who are getting very, very low returns on their savings, including on the savings with the banking system.
Exactly. I view it as, in fact, it's a repression tax, liquidation tax of the debt, but it's really a wealth transfer in the form of purchasing power from savers to the government that offsets the amount of debt. Is that fair to say?
It's not just the transfer to the government, because the government tends to
Correct.
be a borrower. But for anybody who is a borrower, which happens to be a very large corporations, rich people, they're borrowing from the poor. And so this is a very unusual situation in which rich countries are actually borrowing from the poorer developing markets. And that's the current situation right now. That's why I have always maintained that the people who is going to pay for the quantitative easing of the advanced markets are going to be the emerging markets.
Is it fair to say that the tremendous growth in inequality that we're seeing more pronounced maybe since the financial repression in the developed countries is stemming from financial repression?
Absolutely. I think people tend to forget that quantitative easing and the current leverage play is worsening inequality around the world. First of all, as I mentioned earlier, the old who are savers in the pension funds and the insurance funds are getting very low returns. So that's a tax on them already. And then the young and the poor who are saving mostly in the banking system are also getting almost zero returns. So they're also paying for it. Who are the people who can borrow from this? Borrow large sums of money? The rich and the privileged. There's a very interesting paper by two Dutch central bankers. I can't remember the names offhand, but they did a major study on unconventional monetary policy, which is basically quantitative easing, on inequality in Japan. And of course, as you know, the other side of the repression tax is that when you bring interest rates down to zero, asset bubbles tend to increase. The land prices go up very high, stock market prices go up very high. Well, the poor can't afford to buy land. The poor can't afford to buy stocks. And guess what? It's the rich people who borrow money, and play the carry trade. They basically borrow cheaply and invest in stocks and land and benefit from that speculative action. And so that worsening of inequality, particularly in a country like Japan, which used to be very equal, is very, very noticeable. So if this has worsened inequality in Japan, you can imagine what financial repression does for countries like the United States, Europe, and a lot of other emerging markets.
The Financial Times last week, Ambrose Evans Pritchard published an article talking about the strength of the United States dollar and the damage that it was doing. And what he specifically laid out is that since the financial crisis and the zero interest rate policy in the United States, there's been about $9 trillion that's moved out globally. That's really a U.S. carry trade, and a huge amount of it is moved into the emerging markets. And now, and the cardinal rule sin of the carry trade is to borrow in a weakened currency. So now with the United States currency increasing at such a rate, and the borrowing in Asia and emerging markets so large in U.S. dollars that are now going to have to be paid back or interest paid on a devaluing currency, that is a huge squeeze. That's causing multiple problems, multiple issues. Is he right in that observation?
He's absolutely right. I think people tend to forget the role of the dollar when it starts to fluctuate from weak during the crisis to strong now. When it was weak, the dollar was the borrowing side of the carry trade. Mm-hmm. You borrow dollars at very, very low interest rates, and you go and invest in emerging markets. Okay, so the emerging markets then have an asset bubble because a lot of hot money flow in, and now and the carry trade guy wins. Okay, and today with both the ECB and the Bank of Japan wanting weaker, they say that they it's not aimed at the currency, but de facto the quantitative easing is basically weakening the euro and weakening the yen, and therefore strengthening the dollar. So anybody who now borrows euro and borrows yen and then punt either the emerging markets or invest in the US dollar is going to make a lot of money, right? So, basically what has happened is that with interest rates in advanced markets historically low and at negative real terms, the markets are highly distorted. Central banks have been pumping $1 trillion a year into their own balance sheets. And this is completely unheard of. So central banks today account for 8% of the total assets of the financial system globally. And they are changing interest rates, they're changing risks, they're changing liquidity, and they're changing the duration. That means, they're buying the long-term paper. Where is the free market? The free market's supposed to be you and I, the retail guys and the companies, and the real market, nobody controlling it. But at the moment, the major central banks have a huge influence on the market. The market is now policy-driven. It's not market-driven. So, we're in a very precarious situation in which emerging markets are now going to pay big time for these reversals and inconsistencies in the policies between the different central banks.
The Bank of International Settlement was out last week articulating very close to what you just said and warning and major concerns, and they were pretty strong with it. Andrew, I want to switch gears a little bit, but bridge from this, because you wrote just an excellent article called America Made Financial Repression recently, and you featured some of the work by Robert McKinnon. And I wonder if you could kind of summarize the key points in that paper that you wrote for our listeners.
Well, we all understand why the United States needed to go down to very near zero interest rates during the crisis, right? The fundamental reason for that, and everybody understood it, was the politicians refused to do the sort of prime pumping necessary, and so the central banks had to get in. But of course, the lessons from Japan was that it's easier to get in, but it's very difficult to get out. And that's exactly what the Fed is now facing, that it's not easy to get out of a quantitative easing because those people who have borrowed a lot of money don't want that exit to come. And the result is that we are locked into a long-term period of very low interest rates, and these low interest rates exacerbate inequality and actually become self-fulfilling. As you know, in the 1930s, I think it was Professor Irving Fisher, talked about debt deflation. And those people who got a lot into debt then spend a lot of time, even at low interest rates, trying to get rid of their debt, and creates what the Japanese call a balance sheet recession, right? Mm-hmm. Those people who've gone into huge debt now basically are not, even if the government is printing money and encouraging the banks to lend, they don't want to borrow. They basically want to repair their balance sheets. So instead of spending, which will drive back and revive growth, they're actually paying off their debt, and therefore, demand. There's no demand in the economy, and there's a lot of excess supply, which is why we're getting more deflation, slower growth, and in the foreseeable future, very slow growth globally, which means that we're almost seeing a repeat of the 1930s this time round.
Now, Ronald McKinnon, some of his works, he talked about, in fact, Asia having a common currency, but certainly something along the lines of a dollar renminbi standard would help contribute to alleviating financial repression. Is he right in that thinking?
Well, he basically said, and I think he's absolutely correct, that a strong dollar is good for everybody. The dollar is the benchmark, right? The dollar is the benchmark, and if emerging markets stick to the dollar and make adjustments around that dollar, it's better than everybody trying to depreciate or appreciate or whatever. Okay, So the situation, is that when the dollar gets out of whack, because the interest rates are out of whack, then the whole world needs to adjust to the dollar, because the dollar is actually the currency standard. And Ron McKinnon's fundamental point was that if you really look at growth, China grew very well when actually it was the renminbi was more or less linked to the dollar. It's very, very stable. But of course, there was this, just like when in the 80s there was this Japan bashing, there was a period of China bashing, because that China had to run the current account surplus. Well, the Chinese current account surplus virtually disappeared. It's now gone down to about 2%, which is within the range. And in fact, if it wasn't for the services surplus, the trade balance is more or less equal now. So Ron McKinnon was one of those who basically maintained that strengthening the emerging market currencies don't necessarily, like the yen or the renminbi, doesn't make that currency, doesn't make the balance of payments adjust. Those are structural issues. So you just adjust the prices up and down. It doesn't solve a lot of the problems. As a dollar yen or a dollar renminbi standard would then force the country to make structural adjustments.
Exactly.
Okay. So instead of wishing that the yen would depreciate, if the yen was actually pegged against the dollar, and let's say 100, the Japanese the authorities would be forced to make the structural adjustments rather than keep on postponing it, because a weaker yen would postpone that inevitable day of structural adjustments. Abenomics is having problems because the third arrow can't be shot off, as it were, right? Which is basically the structural adjustment issues.
I think that's a standard issue right around the world, is all of the economies are not making the structural adjustments that need to be done. Whether we're talking Japan and Abenomics, whether we're talking the EU, whether we're talking the United States, and we're just talking China, etc. So we're all reacting, we're all kicking the can down the road, we're trying to get from day to day, as opposed to major structural changes that will begin to alleviate some of these until there's a crisis.
I agree with you. The problem is that the kind of thinking of QE, quantitative easing, unconventional monetary policy, all this appears that there is suggests that economics is a free lunch. There are no free lunches. If you don't make the painful adjustment now, you're going to pay for the pain much, much later. Okay, Larry Summers used to say, you would prefer your tooth pulled out fast, or you want to pull your teeth out slowly, right? And that's what we're basically seeing. If you don't make the painful structural adjustments now, you're going to have a long toothache for a long time to come, and that's exactly what we're facing. Nobody wants to face up the structural reform issues, and everybody's kicking the can down the road.
Exactly. Can you help with our listeners, Andrew, describe the effects that the speculative inflows of hot money into China are having and weakening China's macroeconomic tools, and in fact fueling maybe more financial repression? Well,
the problem is that we saw this during the Asian crisis.
Yes.
Okay. Particularly in Thailand, in Malaysia, in Indonesia, and then in South Korea. When you maintain more or less the dollar peg, and you have this hot money coming in, it's very difficult to manage your own monetary policy. And if you relax and say, well, that hot money is good, then you get yourself into the asset bubble, and you pay big time for it. And of course, the Asian countries learn from this, and therefore they let the exchange rate go. And then they built up after that a very large foreign exchange reserves as defenses, okay, which is what China's got. very, very large foreign exchange reserves in case, this hot money, were to worsen it. And of course, China still got exchange controls. But no exchange control is perfect. And therefore, the hot money can still go in. And therefore, in a globalized world, monetary policy is not that effective. Or in the old way that was explained. Okay? We are now highly related to each other, because of the trade links and the capital flows. Now, the minute that the capital flows become highly speculative, then the central banks end up with even more kind of unusual policies. So you get unconventional policies to start off with, and to deal with unconventional distortions that are as spillovers as a result of unconventional policies, you adopt unconventional, even more unconventional methods like exchange control, etc. The free market is not allowed to work, and therefore investors and the poor retail, who doesn't understand all this, is subject to high volatility in all these areas. Okay, and because speculation becomes part of the game, everybody lose sight that it's the real economy that matters. It's the real economy that creates jobs, not tearing up bits and pieces of paper and suggesting that you are richer because you've got more pieces of paper. Okay? And I think that's the heart of the problem. We need to go back to basics. And we're not, because as long as central bankers are still printing, we've got a paper economy, not a real economy. And then that's where financial repression really harms the system, right? But unfortunately, it's the politics that doesn't allow the adjustments to happen, and that you know this better than me. So it's very difficult for me to comment on the way politics get into this game.
Yeah, my close associate Richard Duncan in Thailand, I've written a number of books, and argues that capitalism, we no longer have capitalism, we have creditism, and that is we are not producing wealth on the main street, if you would, and that the wealth that creates savings and is reinvested into productive use. In fact, what we're doing is we're just exploding credit in lieu of it, and credit is not capital. Credit is not wealth, though it does help in the short term with liquidity, and this most often does not end well.
Well, you see, the problem, Richard Duncan's absolutely right. The problem is that people equate finance with debt.
Yes.
Debt is about risk shifting and not about risk sharing. If you think about the issue very, very simply, the real economy is the horse and the finance is the cart. And the horse and cart will move if the horse can still move. Now, we had a situation in which, the people who were sitting on the cart got a little bit punch-drunk with debt, and the cart turned because the financial sector itself was over-leveraged. Okay? And how do we solve this problem? We print even more money. When you're already punch-drunk with debt, do you solve it with more debt? That can't be right. Now, so, the regulation after 2007, 2008, Dodd-Frank, the Basel III, etc., they're focusing on deleveraging the financial system. They're focusing on the cart. So they're putting the cart before the horse. So 7 years after, the crisis, is the horse stronger? And the answer is no. The horse is actually even more weaker. The horse is more leveraged, right? The horse needs capital. The horse doesn't need more debt. So you can make a Rolls Royce of the cart. This is what people like Dodd-Frank and Basel III wants to do. You want to have a kind of fail-proof. If the cart fails, you don't want the horse to bail out the cart. But if the horse is already dying, the horse can't pull the cart anyway, and that's where we're in. So are we surprised that we're asking the horse, which is already tired and slowing down, to give even more resources for the cart, which is actually highly unequal, highly wealthy, and sorry if some other people are going to pay for this. That's what I don't understand. They've lost common sense.
Nor do we. Nor do a lot of people.
Don't get this. And I'm the old-fashioned central banker, right? This current generation of central bankers have violated Walter Badger's rule, right? That the interest rate must reflect the true risks issues. And now that you make the benchmark currency and the benchmark interest rates below the inflation rate, the whole system is distorted. So we have a shift in generation in central bankers. As what I'm hearing, there's a whole new belief and attitude compared to those 25 years ago. Well, we're still, Keynes was absolutely right. The ideas of dead economists, and Keynes is already dead for more than 30 years, are still influencing this generation of thinkers, right? And the policymakers. But the issue is both ideology as well as politics. And because politics is so fractious, central bankers says, well, they can't be helped, we're going to go in. But the minute they go in, they don't know how to get out. That's the problem. That's the dilemma that we're in.
Andrew, we have to wrap, but last question for you. What's keeping you up at nights worrying right now in the global economies? What's troubling you the most?
What's troubling me is that we're heading for another crisis, but the crisis will not be the same as the last one. And so we've strengthened the bulwarks against anything like the last crisis happening. But, things like global warming, geopolitics, terrorism, climate change, inequality, which is a fundamental reason why we've got all these civil unrest, religious fundamentalism, etc., is a new game. And so here we have conventional theory, which starts off with ceteris paribus, which is other things being equal. Other things are not equal. Other things are unequal. And the result is the theory is out of the window, and only common sense will help us. But common sense is not too common, so I don't know, how to fix this problem.
Andrew, thank you very much. Just great observations, great facts. Is there any way that our listeners can follow more of your work and your thinking?
Well, go to my website. It's andrewsheng.net. A lot of my recent articles are there. I'm actually in the midst of writing a book on this issue and examining, the emergence of China and the emerging markets. Development theory is changing. If you read the latest World Bank World Development Report, you will see that thinking is beginning to change. But the danger is that we're still fighting the last war, using the last war's tactics and strategy, and that it may be a little bit too late to stop the world going into a deeper recession, and maybe a crisis in different countries evolving in different forms. What I hope is that we're not going to go into a third world war in order to get ourselves out of the recession, like the Second World War, pulling the world economy out of the Great Depression.
Let's just hope. There's a lot of people that are not quite as optimistic as you in a potential global conflict looming in front of us. But let's pray. Andrew, thank you very, very much. We have to break. I definitely would like to have you back sometime in 2015 and comment on the kinds of things that we see evolve within. So thank you very much.
Not at all.
Talk to you again.
Thank you very much indeed.
Bye-bye.
Bye-bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.